and we'll get started in just about 15 seconds. So you want me to kick off this month, Ken?
Yeah, I think that sounds good.
All right, well, let's go ahead. Well, welcome everybody to the March edition of the Roundtable. I'm joined here by my friends Ken Kavula, Lynch, Hugh McManus, and yes, we still have Hugh. He's lingering and continuing to celebrate St. Patrick's Day past in his attire today on the cover page. And my name is Mark Robertson. And we did put a little tribute to Mega Millions on the cover page of the session today for all the things we were just talking about. You know, one, I was amazed by the amount of attention that Forbes, the magazine, paid to the lottery situation yesterday. And as we made the point a few minutes ago, you're here today because you either lost the lottery yesterday or won. And one of those two things is true. One of the things we do like to point out at this stage in the program is that if you know somebody or if you yourself wants to be notified of future programs, you obviously can access the program through several different ways. But if you want to be added to the mailing list, Ken Kavula's email address is in this link at the bottom. And again, feel free to share that with others who may be interested in getting notices on attending future sessions. But we look forward to doing that. All right, let's go ahead and kick into, well, first of all, keep the legal department happy. This session is an educational session. Everything we do here is for illustrative purposes, and it's particularly true for today's session when we'll be talking about real companies in real time, expressing opinions. You shouldn't run out and buy based on the opinions that you hear expressed, and no investment recommendation is intended. In the spirit of many things that we do, both at Manifest Investing and at our host chapter here for Better Investing, the Mid-Michigan chapter, we do a lot by demonstration, by exploring together, and that's what this is all about. Keep that in mind, and please, please, please do your own homework. All right, I thought we might shuffle things up a little bit here today. For those of you that are new, extra big welcome to you. Those of you that have come to other previous sessions, we've been doing this now for a couple of years. I'll kick things off with a brief introduction, and then we're going to shuffle things a little bit and kind of sprinkle the stock discussions on the individual companies throughout the session. Just kind of bounce around, and we encourage people both in the audience and all four attending nights, and we actually do have one of our guest damsels in the audience. Ann Manning is here also this morning, and encourage anybody who has comments to either raise your hand or enter a question or a comment using your questions tab on your management panel. Just as a quick reminder, we have been doing this for a couple of years now. We try to get together once a month. We try to pick investments that improve our probability or the chances that we can generate a long-term return that is 5 percentage points, 500 basis points, better than the Wilshire 5000. So we benchmark against the Wilshire 5000. Then we would also like to see basically 60 to 70% of the selections that we make outperform that benchmark, and as we compare them over like periods of time. How are we doing so far? Well, this is the point in the program where I generally like to be quiet. Most of the people here, with one notable exception, actually are operating somewhere pretty close to a zero relative return. In fact, Mr. Kavula, and in fact he gets to lead off because he has actually bumped into a positive relative return for the selections that he's made over the lifetime of the contest. We're not deterred. I mean, eventually I will, I'll start listening to Ann more closely, or I'll figure out a good idea for some future selections. But collectively, we have been improving. Keep in mind that we were at a -8 relative return about a year ago. So we're definitely making progress towards target. Our accuracy has improved lately to greater than 50%. That also was less than 40% in recent months. So we're undeterred, and we continue to march forward as good knights would. And thanks to all my fellow knights for not picking on me too much there. Thought we'd share one picture here that kind of puts the, again, we talk a lot about context when we talk about long-term investing, kind of puts our current situation in a little bit of context. And what you're looking at here is a picture of the Wilshire 5000, that index as measured by the Vanguard Index Fund. VTSMX is the ticker. But you see the stock price bars, or the fund index price bars, from left to right, and you can see somewhat of the flat decade, although as the blue trend line points out, there is a little bit of left to right movement up. And as everybody knows, we set a new multi-year high again just this past week. In fact, closed at a high yesterday. Superimposed on that is if you had taken the Value Line investment survey and graphed the average or median low total return for all the companies in the guide. And again, when we explain this, we basically say high is good. High is, higher projected returns means higher forecast levels. Factoring the depths of the bear market and the Great Recession, the returns on stocks were up in the 20 to, in some cases, 30% range. That was the time to back up the truck. This period here was not as favorable a time. The forecasts were actually lower, so it was a time perhaps to be a little bit more careful as we approached this peak. So again, where are we today? Well, frankly, we're somewhere pretty close to the middle of that long-term trend. If you look at just the red forecast line, somewhere in that 7 to 8% range means that we're pretty much in the middle, perhaps shadowing the lower side of the middle of that range from a long-term perspective. And I would invite our fellow knights, how do you look at this, and how does it actually change, or would it have any influence on investing decisions that you make?
Well, Mark, I'm viewing it from the point of view that in order to begin to have some real problems with the market, we'd have to begin to approach those historic lows that were down in the 5% or even below 5%. I'm feeling not super confident, but I'm feeling that as long as the returns stay somewhere, around 8, 9, 10, 11%, that there's probably room for the market to continue to expand.
Yeah, I agree with Ken on the overall outlook. As for impact on my investment decisions, with the low return forecast, as you say, in the middle, maybe the lower end of the middle with my par below 8%, I do accent financial strength and perhaps stability a little bit more than I would if those were both double-digit things. So I'm tightening my quality a little bit as the result of being in the middle range. And I also recognize it's not on this chart, but a indicator that I also watch is the VTSMX par, the par for the total market as a whole, which right now I think is running right around 10 or 11%, and compare it to to my par, and when that is above my par, that is showing me that there's more shopping in the larger, more blue chip type companies. So again, I'm steering a little bit towards safety right now, just to prepare for a potential downturn.
Yeah, and Hugh, I guess I've noticed you've kind of been leaning towards the larger companies, the Staples, the Costco's. Is that any way influenced by any of this?
Not really. I mean, I generally don't look at the global outlook too closely when picking a company. I tend to be very company centric. I might look at things like, well, I look at revisions of GDP and of average household income to see how those are panning out. They've shown recently the recovery is a lot stronger than was initially anticipated. But I tend to look at individual companies more than the forest, if you will.
Yeah, would that influence you though to shop more in the retail side of things, your Staples, for example, and things like that?
Well, it would, and the other thing I'm waiting to happen is for the brokerage houses to start bouncing back again, which ultimately will happen. They've been languishing. A lot of the financial sector.
Sure. All right.
As people get more money, things will improve, you know?
Sure. Well, let's go ahead and move on. Let's go ahead and go to our first stock presentation. In fact, Ken, I think we need to switch the screen back to you.